welcome to lesson 7. We're going to be diving into break and retest. We're going to talk about why it's important and how to properly use break and retest. So we already know that the market consists of steps, right? Like a staircase. Kind of look like this. And also going down as well. All right, so the market looks like this. You basically have steps going up and you have steps going down. Make that red for us. Now, what a break and retest is say we have a little area of interest right here. When we're bullish, we're going up. We break above this structure point, and then we retest this structure point to continue going to the upside. So make another little area of interest right here. We broke above, creating a new higher high, new lower, higher low, retested this previous structure point, and then it just repeats itself. Another little area of interest right here. Broke above, creating a new higher high, new higher low, retesting previous structure point, and continuing to the upside. That's break and retest. Our goal is to catch moves like this, or 1 to 2 risk to reward. We want to get in on this sniper entry, retesting the previous structure point. Want to make sure that we're rejecting the previous structure point. I'm going to put that down. Make sure we are rejecting the previous structure point. Get your rejection, get your entry signal, and then since we are in an overall bullish time frame, we're in an overall bullish trend, we're going to buy. You want to buy somewhere in this area, add an area of interest. We're above the area of interest. We are bullish. So we're going to get in on this retest of this previous structure point. So that's what we're retesting. We're also retesting this area of interest. We're above the area of interest, so we're going to be buying. You get in on the retest to get your best possible entry. Now, of course, you can wait for your entry signal, your engulfing 30-minute, 15-minute, 1-hour shift of structure to then enter the trade. But make sure that we are getting our proper rejection so we know that the trade isn't turning around. It's going to do something like this and take us out. So you always want to trade in a very clear, easy to read market. Something like this right here. One reason that I love head and shoulders patterns so much is because that's what this is. It's a break and a retest of the area of interest. So right here, we have a daily area of interest. Daily area of interest right here. And I see right here that I could also have a little 4-hour area of interest. Something like that. I'll make that darker so you can tell the difference. Have a little 4-hour area of interest. So we have a 4-hour area of interest inside of a daily area of interest. So what happened here? We had this head shoulders pattern. Here, we had our left shoulder, we had our head, and we had our right shoulder. We broke below. There's our head and shoulders right there. And then, as you can see, this wick right here came up, retested this area of interest. After we broke below, we are now retesting this area to then get our sniper entry to sell. If you want to wait for extra confirmation, go on the 1 hour so that we can see it a little better, see where our entry would be, because we look for our entries on our 30-minute and our 1 hour. So right here we have this break of this neckline, and then we had the retest right here, that bullish candlestick. Could have gotten in right here. If you wanted to wait for extra confirmation, you could have also waited for this engulfing right here, or you could get in on this engulfing. I always wait for a retest on a head and shoulders pattern just so that I get my best possible entry. And sometimes it won't give it to you and you miss out on the trade. There's always another trade out there. Don't worry, don't get FOMO. If the opportunity comes up, take it. If it doesn't, move on to the next one. And then you could have just rode this down from 1 to 2. If you wanted to continue to hold, this would have been at a 1 to almost 4. We could stretch that out even a little bit more to get these lows down here, and you would be at a 1 to 4. So whatever you're risking times 4, that's what you would make on your profit. So that would have been an awesome trade to catch. I did not catch that one, but you kind of get the gist of the break and retest, especially on a head and shoulders pattern. So if you intertwine your head and shoulders pattern with your break and retest, that gives you a higher probability trade setup. But remember, the head and shoulders is a reversal pattern. So I made sure that I rejected the previous structure point right here. We rejected it here. Could have gotten on here because then that would be confirming that we are rejecting it. Entering down here. Even if we had entered down here and caught that big move, catching these lows down here, we would have ended with a 1 to 3. And that was waiting for extra confirmation. Whatever you're risking, times 3, that's what you make in profit. So, still waiting for extra confirmation is extremely important. Sometimes I like to take the riskier setups just so that I can get that extra risk to reward. But it's entirely up to you and what you feel comfortable with risking. If you want to be on the safe side, wait for that confirmation, wait for the engulfing, and then enter your trade. Make sure you have a sufficient stop loss above the previous high and the wicks. So this was a great trade, great reversal trade, great break, retest to then sell. But remember, you always want to wait for your candle to close, just so that you know that the market is confirming to you that's where price is now. So you wait for the candle to close after it breaks. Then wait for your retest of the previous structure point. Just like that. Just like we had here. And we can even go into the 30-minute. We actually shifted bearish here, giving us a lower high and a lower low, and then giving us a new lower high and a new lower low once we broke below this structure point here. So we were bearish here and here. So of course our entry is going to be in between these two areas, our lower high and our lower low. Waited for our retest of the neckline of this head and shoulders, and we sold right here. I'm going to put right here, always wait. Put right here, always wait for a clean break. Meaning body candle close. So right here. Let me mark that right here. Here's our body candle close that we would have waited for. Right here. So that was our break, retest, sell. So a few common mistakes that a lot of traders will make is fake outs. They'll get in on a wick or think the candle's about to close and go ahead and get in. Always wait for your candle to close. Here's a perfect example of, again, a head and shoulders pattern. Right here, you got your left shoulder, you got your head, got your right shoulder here. You've got your neckline. Make a little area of interest right here. Got your neckline of your head and shoulders. We have our head and shoulders right here. Now, let's say somebody saw this head and shoulders, saw this right here starting to come down. So they're like, okay, perfect. I see this wick, I see this body. Let's go ahead and get in. Short position right here. He sees it, puts his stop, puts his take profit, and then price wicks back into the area of interest because it didn't close, it didn't confirm to him that that's where price was going. Price came back up and took him out for a loss. But this is a perfect example of a fake out. A fake out head and shoulders. A fake head and shoulders. A head and shoulders that looks like it's got a lot of potential to reverse, break, retest, and then sell, but we didn't get our confirmation. We didn't get that closure of a candlestick. Price continued to do its thing, and then he got taken out. All right, so I'm going to put common mistakes. One is entering a fake breakout. Solution to this is waiting for closure of a candlestick confirmation. Always wait for that closure of a candlestick so it confirms so that we don't get taken out by a fake out. Ignoring the higher time frame. Remember, the higher the time frame, the stronger the confluence is. So if we have a daily closure, we're waiting now for a daily retest of a daily area of interest. Okay? So if we have a daily head and shoulders, we're waiting for a daily retest. If we have a 4-hour head and shoulders, we're waiting for a 4-hour break and retest. If we have a weekly head and shoulders, for example, we're waiting for a weekly break and retest. Okay? So don't ever ignore the higher time frames. If you're at a daily area of interest and you have a 4-hour head and shoulders, great. That's a great confluence. Especially if the daily and the 4-hour are both bearish, or the daily and the weekly are bearish. It's going to help you wait for price to get below that area of interest, let it have that break, let it close, then wait for that retest. If it doesn't retest, I don't typically get in the trade. For example, if this candlestick right here was replaced with this candlestick, and we were waiting on an engulfing and a retest, see the size of this candlestick, let's move it over here. The candlestick would have closed down here. That's half of our take profit. So you wouldn't enter that. It's too late. The trade moved on. It depends on the candlestick. If we were to enter down here, our stop loss would need to be above the previous high which would put it right here. And that is just crazy. We are not going to take that trade with a stop loss that's bigger than our take profit. That's not going to happen. That is not going to keep you profitable in the long run. So it depends on the size of the candle. So I'm going to say here, don't force every trade. If the trade works out the way I should say that if the trade setup works out the way you are anticipating, then take the trade. If it doesn't, don't take the trade. You want as many confluences that you can get, but you don't want to force the trade if you don't feel comfortable putting in and putting behind all your money when it didn't even do what you anticipated on it doing. You are anticipating the market. You are letting the market tell you what it's going to do, and then using your judgment, your confluences to take the highest probability setup. I see this a lot with traders. They will place their stop losses at not the correct points, which will then take them out. Even if they're correct about the direction, it will take them out. It'll wake them out, it'll take them out, even if they're right about the direction. So always have an appropriate stop loss. You always want a stop loss that is above your previous high or your previous low. Another common mistake is poor stop loss placement. Right here, so let's go back to our head and shoulders. This head and shoulders, or which one were we at? Yeah, right here. Right here with our head and shoulders. Let's get our short position. This is where we would have entered. So a beginner trader would have tried to keep a nice tight stop loss. What does that mean? It means a better looking risk to reward. As you can see, if I had a nice tight stop loss, let's just do it to the top of this daily area of interest that we have, and then target the previous low, we'd have had a 1 to 5. Now it looks good. It's like, whoa, yes, absolutely. I want 5 times what I'm risking. Say I'm risking $1,000 right here. Make 5 grand in one trade. That's awesome, right? Well, the likelihood, and no, it wouldn't have happened in this instant, but the likelihood of getting taken out of this trade is very, very high because you have such a tight stop loss. What you want to do is you always want to put your stop loss above the previous high if you're selling, below the previous low if you're buying. But I don't even want it right here. I want it up here. I want it a few pips above the previous highest wick to make sure that I am not going to lose this trade. And if I lose this trade, then I was completely wrong. And I get it, whatever. That's what happens sometimes in the market. But I'm going to be as safe and secure as I can when I'm putting in $10,000 on a trade. I'm okay with a 1 to 2 risk to reward. As long as I'm not losing, my butt on all these trades, you want to keep a nice, healthy, breathable stop loss so that the market has plenty of room to breathe. If it needs to come up here, retest another structure point, it can. In this instant, yes, this tight stop loss would have worked. I do not encourage a tight stop loss. As you can see, you have a lot of high wicks, high wicks, high wicks, high wicks. So let's just go over real quick. If I have a little area of interest right here, so we are currently bearish. Let's say I was going to enter a short position after this closure of an engulfing candlestick. Where do I always want my stop loss? Above the previous high. So I'd want to put it right here and above those wicks. However, as you can see, let's say that beginner trader puts his stop loss very, very tight, give it a nice tight stop loss, and then aim for a 1 to 2 risk to reward. Okay. So he gets in the trade, he enters here, okay, everything's, price is right about the same, and then boom, he gets taken out. Look at this wick right here. And then price continues to go down. So he just lost the trade, but his prediction of the market was correct. So we were bearish, but we had this huge wick, huge liquidity grab that took him out. So you need to have your stops placed above previous structure point. Aim for this next daily area of interest right here. So this would give us a 1 to 2 risk to reward. We're above the body, we're above the wick. I could even make that a little bit bigger. Above the wick to make sure that we don't get taken out by this wick right here. So now the trade ends up going to our take profit, as you can see. And we were able to take our profits instead of taking an unnecessary loss by not having our stops in the appropriate position. Right back here, for stop loss placement, I'm going to just put place stops above or below highs and lows. Also place above or below wicks. Let me tell you, when I started to incorporate stop loss placement, even though it wasn't, the best 1 to 5 risk to reward, I would get taken out every single time. I was losing so much more money. Instead of just having a nice conservative stop loss of a 1 to 2, I was starting to win one after the other. And it was because, yeah, your trade needs to breathe. It needs to have enough room to stretch out if it needs. It needs to have enough room to go where it needs to go before continuing in the direction that we have predicted. So I would get taken out a lot, lose money, and then price go in my direction. And I would, I was like, okay, what do I need to do different? I need to place my stops higher. So yeah, it might be less attractive, not getting a 1 to 5, but having a 1 to 2 and doing that over and over again, compounding your capital is way worth it. To be extra careful and extra safe with these markets. So, some pro tips that I'm going to give you guys. Let's go. Pro tips. One being combine, break, and retest with the overall trend of the market. So if the market's bearish, you want your break and retest to be bearish. If the market's bullish, you want your break and your retest to be bullish. For example, let me scroll over here. Oh, that's right. As you can see, we are clearly bearish. We have our lower high, lower low, new lower high, new lower low, new lower high, new lower low. This right here is a perfect break, retest. Now I want to wait for the next break of this previous structure point, then retest. We are also at an area of interest. Get in on the retest, and then I caught this little 1 to 2 risk to reward right here. Price actually pulled back up. I got in again, retested, came back down. 1 to 2, or almost a 1 to 2 is a 1.96. The price came back down, and I'm actually looking for another retest of this previous structure point to get back in. I'll wait for the little wick pullback to then probably get in again. So I'm gonna put my alarm right there or right here so that I can know when is the appropriate time to get in. But I'm waiting for the daily to close because typically we have a wick on the daily. So I'm anticipating for this, the daily wick to come up here, retest previous structure point to then continue sales to the downside, and I'm targeting this weekly time frame or this weekly area of interest right here. So would give me a 1 to 2.23, but that's what I'm anticipating to happen this week. Probably risk about 5,000 on this, try and pull in about $10,000. So yeah, so that is your break and your retest. So the trend is your friend. Waited for the break, the retest. I knew I wanted to sell because we are bearish. Waited for the retest, this area of interest, also the previous structure point. Got the rejection, could have entered here. I got in a little riskier entry, got in up here, and then caught the sells for a 1 to 2 risk to reward. So always combine your break and your retest with the overall trend of the market. The next pro tip, always look for your area of interest. Of course, the trend. And I also like looking for round psychological levels, which are, like I have right here, 1.175, 1.17500. So psychological levels are every 500 points, no, probably 50, 500 points in the market. So I've got this round psychological level here. Our next round psychological level would be, let's mark it. Here at 1.1800 or 8,000. No, that's only 3 zeros. I couldn't tell if that was 3 zeros or 4 zeros. So it's at every 500 points you get around psychological level. And what is that? That is a liquidation period for banks, institutions, hedge funds. They would rather have a round psychological level of a very even number to liquidate billions and billions of dollars rather than, a random number like 1.18241, right? So it's for banks, institutions, and hedge funds to stay more organized. So a lot of times you will have liquidations at these levels. Let me find an example. As you can see, we have a round psychological level right here, 1.17500. Price rejected at once, twice, 3 times, 4 times, 5 times, and then eventually a huge liquidation occurred here on the daily time frame. So they're definitely something to look out for, especially when you have them in an area of interest that makes your trade an even higher probability of going in your direction. I've got 2 more pro tips for you guys. First one is be patient. Guys, I can't express this enough. You gotta be patient with these trades. Let the market show you what it's going to do. Get that confirmation, okay? Let price be at your area of interest, break below or above the area of interest, whether you're buying or selling. Let that candlestick close. When that candlestick closes, as an engulfing, you can wait for that retest to then enter the trade. Be patient. The money is in being patient, doing nothing at the time. You're literally just waiting for these setups to occur. If it happens, it happens. Enter the trade. If it doesn't, move on to the next. It's as simple as that. Just be patient. You don't need to catch every trade, even if it goes in your direction but it didn't do exactly what you wanted. Don't get in. Okay? Don't get upset with yourself if the trade went in your direction but didn't do exactly what happened. Because in the long run, you will be more profitable if everything checks out, if all your boxes check off. Next is journal your trades, which I should do better at. I'm very bad at journaling my trades. I do it now, and then the trade happens or it doesn't happen, and I move on. It's good to journal your trades, and I used to a lot when I was first starting out, but I get to a point where I either win or I lose, and then I just move on, But I need to do better at journaling my trades. When you journal your trades, I have found that you find what you are doing wrong. If you have a loss, okay, why did I lose? Journal that. And journaling helps to improve your personal win rate. So journaling your trades is key to finding what you did right or wrong. So to pretty much sum everything up, this is our break and retest section. Always wait for your confirmation. Entering a fake breakout is something that you want to avoid. Always wait for that candlestick closure. Waiting for that will save you a lot of money and a lot of losses. Don't force every trade. If the trade setup works out the right way, works out the way you were anticipating, take the trade. If it doesn't, don't take the trade and just move on to the next trade. Poor stop loss placement. Place your stops above or below the highs, depending on if your highs or your lows, depending on if you're buying or selling, and also place above or below the wicks so that you get your highest probability of it not stopping you out and then continuing in your direction because you trade with the trend. Then my pro tips right here is combine break and retest with the overall trend of the market. So if you're breaking and retesting and you're selling the market needs to be bearish. Or if you're buying the market needs to be bullish. And you want to look for your areas of interest, your trend, and your round psychological levels, which are every 500 points in the market. You guys also need to learn to be patient. Patience pays. Patience pays. I'm going to make that big and bold. Patience pays. Boom. Patience pays. Literally, patience pays you literally. Wait for your confirmations, wait for your confluences, then enter your trade. We need to make sure that we are rejecting our previous structure point, get our rejection, our candlestick rejection from the previous structure point, letting us know, okay, price is reacting at this point, wait for our entry signal, boom, get in on the retest. Yeah, that's pretty much it. If you guys want to copy these down, feel free. Patience pays, don't forget. But yeah, so this was the break and retest lesson. I hope that this made sense. I hope that you guys got it. Go practice it, get your chart time in. Patience pays, don't forget that. And I will see you guys in lesson 8.